1/2/2012 S&P 500 index weekly at that. As our new year begins in the S&P 500, we're going to be looking at some bull cases. And part of the bull case is that there are areas of resistance that we could come over here to 1290. I will also show you this 1300 neck level that was back over here is going to be a key issue, MMTs. That's going to be this level right here. This is that level that was on 5/29 of 2011 when we were originally shorting early and late April of 2011. Now we're starting 2012. But we can see that clearly both wicks of this week right here was 619. And we can see that that high was 1298 on the S&P. That's going to be a resistance level. That's the upside for the bull. A lower level of that same level would be 1292.50 on the upper end, and they were selling in these weeks, and that was 6/12 of 2011. And the 6/12/2011 high was 192.50. Okay. Now, having said all of that, there is for the bull, and we're talking about for the bull case, is that they have some little upper levels that you could come to, and we will put in that 13. We'll go back to the lower end of the week, which would be right here. And that was, at the time, that low was 1311.8. And what we'll be looking at, should we clear that area, then that's an area of resistance. Once you clear that 1300 handle, is that this was that previous calendar year, 2011, high at 1312. That's that week. 522, we were shorting back in those times. But that's ultimately, if the bull case starts the new year and you were to have a good earnings season, we don't see that being the case. We are just simply showing what the shorter term levels of resistance are going to be. We are going to have to get above the 50-week moving average. We know that. But here is a major bull case for starting the calendar year in standard technical analysis, is that just like we did on the great winner Google, when we the weekly sell signal here has been in play for an extreme week over week over week over week. Well, 2011 is over, but that's what 2011 was doing. We're starting right now, tomorrow, on 1/3 of 2012, the tape, and we're headed toward that weekly buy signal. A weekly buy signal would be a definite victory for the bull, for the upside bull case. To get to these levels, they're going to have that weekly buy signal on what we call a moving average convergence divergence standard technical analysis. MMTs don't make decisions so much. They monitor that public technical analysis, and basically if you get positive here, then the S&P up and out of the money calls can run all the way up here to this 1300 level. That's the upper resistance level. The peak high right here on 1023 rather, was 1292.66 right there within this cycle on this weekly chart. See? So we're going to plot out where the calls go. We're going to plot out if we were to fail here, that's the bull case. The bear case is you don't close above the 50-day moving average. You close below the blue line, the 10-day moving average, and you start coming down and hitting support levels and closing below support levels. That would support the bear case. The bear case has things in their favor as well, starting 2012. And that's these support levels. If they were breached, then they are going to come down. That 10-week moving average is at 1241. A close below the 10-week would support the bear case. The 100-week moving average is at 1207. That's going to be your new rising 120-week moving average rising neckline. That supports that for the bear, but right here, that's a bull case at the weekly moving averages. That's how we're going to start the year out. That would be the bear case if you start to sell into the new year, and we will have shorter time distances that we use. And we have things that tell us when that 50-week moving average, you close above it. But if you close below the 10-week and you come down and you get support, that would be the first good buying opportunity of 2012. Another good buying opportunity in 2012 would be if you came back down here and tested the lows of 1160 on the S&P, which is about 100 handles difference to the downside for the bear case going in with the 2012 calendar earnings that start January. We are in January. So that's the bear case of things. The thing for the bull is they're so close to this weekly buy signal now. That's what it was the previous week, minus 3.69. But remember that part of the weekly buy signal, the level that we're at right now, we're only minus 1.2. That's where money would want to come off the sideline. And the bear, the 2011 bear, would be squeezed higher up in resistance levels. That's what would happen to the bear. They would get walked right up in these markets, right up to this level here. And we'll deal with the current market levels and these, we're at double top highs right now in here on the weekly. But we clearly know that when it comes time to trading index options on the S&P 500, which I'm going to pull up here. Here it is, S&P 500 index. We've got weekly contracts on it, and we have the February contracts on the S&P. Okay, we have a lot of things that are working here on the S&P, and we have a lot of things in the monthly expiration here on the S&P. We've already been looking at the 1250 put. We've been looking at the January 1260 put. There was volume that came in there. That's a bigger, lower interest right here. On the call side, we've been looking at this $1,300 call right here. There's 52,000 contracts open. That's the upside volatility to resistance levels over here in the S&P should we start out the new year. Now remember, it is possible for the bull. However, the bull will have to deal with calendar January 2012 earnings and European debt crisis is in play. And I want people to clearly understand, yes, I could blow my nose on that one because that's the way that the European is, okay? And that this 50-week moving average between the bear and the bull sentiment is money comes off the sideline above it. So we'll be looking at up and out of the money call for the bull side. That's at 1,300 right here. When we were down at levels, we did the 1250 call, but let's not forget that these call contracts were inflated over here. We were buying on the first pass down here in our system. And that was a couple of weeks ago. When we got deflated, they were at 14.20, and then they made their high over here at $52. What a great move. Now they got deflated to 11.20, and the same 1250 call is tradable. It's at a low of 24.70. So it's not as inflated, and it is pulling back. And trading this 1250 call for intraday entries and intraday exits is a key. And yes, it is slightly in the money. If we take a look at the $1,300 call, that's this chart. Yes, they were up here on the week of 12/4 at $26. Yes, the call price, part of our 2011 training, is how the call side of the option market gets marked down and how the put side gets marked down. It doesn't matter. They both get marked down. Now, what MMTs are being taught as this year is upon us in 2012, one of our newest management services that you buy down here at $2, and you sell the markup over here at 960. So the low that happened on 12/18 of 2011 was $2 again. That was the low. That was deflated on that $1,300 call. And that's where you make the transaction. Yes, you can sell into it, and you should. But you're ringing the cash register on the up and out of the money volatility using both the markdown in the call wholesale to exiting. And if you take a look at the 1250 put, it too is marked down and was marked down. Both sides marked down. This is marked down. And it can go lower. And we're going to give bids out at 14.50 right now. The low on 12/25 Christmas Day, or not Christmas Day, but the last print of the weekly that we have there is 17.20. And I'm setting alarms right now at 14.50. I'm setting alarms at 15.70. I want to know if this thing drops to 16.80 and 17.50, slightly right back at those lows that happened on 12/25 of 2011 week now. And it too, once again, is deflated. So both the deflated price here of the 1250 put is wholesale, and the markdown, once again, in our new service, is buying these markdown volatilities. This low was 1120. They took the high on this 1250 call. They took the high right here during that week, starting 12/18/2011. 34.50 was a high. They opened it at 17.80. Then they marked it down from 34.50 to the 11.20 low. That was this low. That was deflated. That was buyable for up and out of the volatility. For the bull case. That's what we do. Then, take a look. Here we are. The low, 24.70. But take a look at the high of that markdown week, starting, the week out, the weekly of 12/25 data. You had a $36 high, and it's been marked down to the low of 24.70. Yeah, it closes at 28.20. And this side from that high of 52.30 on that 12/4, December was marked down and then marked up. Both sides are marked down. Time to trade it.